Right, so those were the headlines, and now our top focus on the show is on the IT sector. Well, IT earnings have wrapped up for the quarter gone by, and it's been a lackluster show overall, and that's against the backdrop of major headwinds like global growth slowdown, persistent demand uncertainty, and concerns over the ongoing tariff policies. Now, TCS is seeing flat revenues, Infosys margins are falling. Overall, the management commentary from some of these behemoths has exhibited a cautious tone. So what can change the game for the IT sector? For how long could the pain persist? And could AI change fortunes of these companies? We'll be speaking with an expert in just a short while from now, but let's take a look at what Infosys management had to say. They recently reported a weak set of earnings. Hear out what Salil Parekh has to say, and then we'll take forward this discussion with our guest who's joining us this evening.
So we feel well positioned in this environment to look at both growth and both cost areas as clients look at them. We see there's uncertainty in the environment. In terms of mega deals, we had 2 mega deals in the last financial year. We have a pipeline of mega deals today. What is sort of what we saw in the past when things of this nature happen, which is changes in the environment. There's also an interest with clients on cost takeout, automation and efficiency and consolidation. We will see how it plays out because it's only a few days as clients have looked at it. But we have seen our large deals moving, meaning which we have closed, moving into the next phases as was evident.
Yeah, so on the guidance, as I said earlier, there are multiple models that we have built. At the bottom of the guidance, we have assumed, heightened impact from all the macro environment. And on the top end of the guidance, we have assumed steady to marginally improving, environment.
And for more details and to dive deeper into the sector and what do these earnings really mean for the overall sector going forward, we're now joined by Sandip Agarwal, Fund Manager at Sowilo Investment Managers. Thank you very much, Mr. Agarwal. You just heard the management commentary coming in from Infosys. Overall, the commentary on the sector has been rather cautious. So what's the overall pulse that you're catching of the sector?
Yeah, hi. Thanks for having me on the show. So let me give you the way how I look. Means I have run a tech company and it is almost 2 decades I have been tracking tech now. So in technology, what happens, 80-90% of the spend which is there from the client is actually the top priority spend. That means that, you can't negotiate that spend in any case because that runs your day-to-day systems, your maintenance, your annual. So it is very, very sticky annuity business. It never comes under risk. Even during during Lehman crisis also, that revenue was there, always there. It can't change. Even in COVID, that was there. So in worst case scenario, your revenue can only decline by 5-6% because 80% of the total revenue is very sticky. The challenge is that, the balance 20% is the last priority. So in IT, you have first priority, 80% of the business which can't be touched. And then there is 20% such business which is completely discretionary in nature and which is last priority. Now, always the challenge comes in this 20% because this 20%, whenever there is a little bit of uncertainty also, this gets postponed, delayed, cancellation, everything happens in this 20%. So my view is that, and this is what we were saying from last 8-9 months, that the index has done extremely well. It has moved up substantially. And now the valuations are unsustainable. And being a presidency change, we have always seen when presidency changes happen in US, we see some trouble for IT because it is a very big business for us. It is a big foreign exchange earner. So there is always some kind of, increase in cost. If you remember in 2014, we saw the increase in localization, which has killed the margin of the sector by 5-6% in last 10 years. So the challenge is this. So this time also, what happens in case of tariff, there is a problem with the country. There will be some negotiation, some solution. But when there is uncertainty on global growth, where your 90% business is coming from outside India, you can't grow till there is uncertainty. So that is our challenge. It is a very different kind of sector where some portion is secured forever and very small portion is unsecured. And that always gets hit hard in uncertain times.
Right. In fact, there's been some weakness over the past many months, and that's due to inflationary concerns. There have been concerns regarding elevated interest rates as well. However, how concerning could this get, given that now there are concerns around a possible recession?
So, there are two, three things. One, if there is a recession, obviously, we have seen in past that, US going into recession has hit all the economies across the globe. The impact can come with a lag effect. And as I mentioned that, while on paper it may look that, different IT companies have different kind of exposure to the US, maybe someone has 40, someone has 60, someone has 50, but the balance 25-30% which is coming from Europe and other developed market also, most portion of that is from the branches or the subsidiaries of those companies which are from US. So basically the whole export is directly indirectly related to US. So if there is a recession, and then recession has its definition, so if it is a mild soft landing kind of recession, then I think the revenues will be secured. You may degrow at most 2-3%, and you can grow at most 2-3%. I think that is the situation today. If there is a very, very tough hard landing like we saw in COVID or post-Lehman crisis, then 1 or 2 quarters you can see a sharper degrowth, maybe 5-7-10%. But then that is short-lived, because when you go into degrowth, then that portion of the revenue is also quite important, and that comes back first. So what doesn't come is the revenue which is above 100%. So whatever you did last year is more or less secured. But anything above that, environment has to be stable at least, if not good.
All right. So on the back of that, what would be your forecast for 2025-26 in comparison to last year for the sector?
So I think this year will be a tough year. I don't see more than 3-4% growth for the industry. And I will tell you the reason, because see, our IT industry by nature is a first half driven industry, except if you leave some of the companies which have higher exposure to domestic, like Wipro has more exposure to domestic and Middle East. So if you leave that aside, we are a first half country. In terms of most of the companies achieve their most part of their growth in the first half, because if you recall, Q3 is a Christmas holiday and manufacturing furlough quarter, and then March is a less number of working days in February, which eats away almost, like, even if you assume 2 days, it takes away your 2.5% of revenue. So we are a first half driven company, and going by the situation we are right now, I think this first half of this year is gone. And if the first half of this year is gone, then second half, no way you can grow more than 2-3% for the full year. It will also be a daunting task. So I think that is what I am making out of the current situation. It will be very hard to, show higher growth than previous year in this year for anyone. It will has to be a miracle. Even if it happens, it will be like, low single digit kind of growth, if at all we go there.
So is there going to be any silver lining to all of this, or is the downturn fairly broad-based?
I think downturn is broad-based, but prima facie, the situation which is there today, I think the worst hit will be maybe manufacturing, because the highest amount of uncertainty is in the manufacturing space, and I see serious challenges there. So and particularly what we are hearing is that ERP is completely right now is in a very dull mode. There is no demand in that space. So again, that is mostly to do with the manufacturing side of it.
So when you say that amongst all of these segments, manufacturing, you're stating that that is going to be the worst hit, but how do you see companies maneuvering to these challenges? And there are quite a lot of them. What's the current thinking that you're hearing from companies, and what are we going to see more of in the IT industry in terms of trends, for instance? Will there be more deal pauses? What are you going to see on the deal conversion front, on decision-making front?
So right now, my biggest fear is that I am honestly fearing that in next 1 month or 2 months, you will see some deal cancellations, and the big size ones. And that is the worst thing to happen, because any deal cancellation, the challenge which happens is that it completely stops all other clients from giving any discretionary deals. And I am honest, if you see last 20 years, every time when this kind of situation on US or global economy has happened, we have seen that in coming months, 1 or 2 months, there has been some deal cancellation. Now, that deal cancellation may be a small deal of $100 million, which is nothing for our size of exports and our size of revenues. But problem is that clients start thinking that better to wait for 6 more months before and get full clarity before we avoiding a deal today and then canceling. That is a challenge. So, as I said, postponements, delays, and cancellation. These are the 3 very, very bad outcomes of this kind of situation, which I'm fearing. I'm fearing that if no deal cancellation happens in next 3-4 months, then I think the journey will be much more smoother, because whoever is even taking and making a discretionary spend.
All right, and now amidst all of these changes, Mr. Agarwal, will it be the year when AI capabilities truly help in sustaining long-term growth on ROI deployment?
AI is something which was always there, but it has now become more acceptable because of the way data is growing. So you need tools which can process the data fast into information, and it has been very, very helpful. Honestly, in our PMS also we are using a lot of AI and to generate good quality research, and it is much faster than the traditional approach. But remember that to write this AI codes and to use them also, and to find in tabulate the information which comes out of it, you need manpower. So I will give you a very classic example. The per capita increase tech cost, it has grown every year in last 40 years. There is a data to support that. So tech cost never goes down. What happens is tech improves your experience, and it improves your efficiency significantly. So what you are able to do today at in 1 hour, you can do in half an hour, then 15 minutes, then 1 minute, but it can never bring down your cost. So the thought that any technology disruption will reduce tech spend, that has never been true. It can't happen. It can only improve the experience and reduce the time, or means improve the efficiency substantially. It has always been like that.
Right, so while there may be concerns regarding the US market, but what are you making of the European market in comparison with the US market? Because it's a given generally, whenever there is softness in the US market, the European markets do look up.
So I think in Europe, honestly speaking, it is very funny. We have seen and we have data to prove that whenever the recession happens or whenever there is any cost pressure, we have seen an inverse correlation with Europe. Europe actually starts more outsourcing because they want to save money. So I am not worried about Europe at all, except that some portions of the manufacturing. I am more worried from that perspective from the US, because in US there is direct correlation. If they go into recession and all, the decisions get delayed and the spends go down. But in Europe, interestingly, we have always seen that as uncertainty comes and the pressure to do cost cutting increases, and they want to say protect their profit and loss account, and in that endeavor they outsource more.
All right, so let me shift your focus to now an interesting trend that we've noticed. Now, Wipro's posted a large deal bookings for the company are up 48.5% year on year. What would you attribute that to? And would you call that as an aberration in uncertain times? Or could that be repeated by other companies as well?
So there are many things like, in tech, what happens that you are working on a deal for sometimes, 12 months also. So we don't know what they have got, what is the breakup of that. But I can tell you one thing for sure, it is not a work of 1 or 2 or 3 months. It is a work which has been going off maybe 6, 12 months, and the outcome we have seen now. So I will rather call it more of a aberration rather than something else. Although because we run a PMS, it is very hard to comment on any company specific thing. But let me tell you that, we have seen Wipro in last 20 years, they have been lagging on performance for one or other reason. And I believe the competition today is very, very tough. So for them to, do something phenomenally better than the industry is really difficult.
Okay, and now I have to ask you this. How do all of these trends, this outlook, how does this translate into jobs for the IT sector, particularly entry level and mid level and secondary? On the salaries front, how do you see that panning out, given that Infosys and TCS are both maintaining workforce size and you do have AI and automation based disruptions that are looming?
So, very interesting. So I can tell you 2-3 things on this. First of all, I have seen that whenever there is layoff, postponement of salary, postponement of bonus, that time we are very close to the bottom of from the stock market perspective. That is the stock prices. Although the business bottoms out after 2-3 quarters. So from a stock perspective, I think this is a clear sign that we are very close to bottoming out on the stock prices. Maybe another 7, 8, 10%. But at the same time, let me tell you that, after this, they go through time correction of 2-3 months also. And then business starts showing improvement. So I think that these actions which you mentioned, it clearly suggests that we are on very close to bottom in terms of the IT index. Now, second point, which also substantiates this, is that this AI, which we are talking about, and the new DeepSeek and new technology, whenever they come, first 3-4 quarters are most painful. As I said, we need to train huge workforce. We direct, indirect, whoever is employed, more than 2 million people and all that. So I think we are on that situation where 4 quarters have passed by. So from that perspective, also I think from here you will see incremental benefits coming in. But again, as I said, this tariff and this US recession is a new problem. Otherwise, ideally, if this tariff war would not have happened, or US recession concerns would not have been there, I think we would have seen some recovery in the tech sector.
All right, so some disruptions are expected to come into the IT sector on account of global geopolitical changes and, of course, on AI and automation-led changes. You're stating that AI-led automation will lead to spends on training workforce, so incremental benefits are likely to come in. But on that note, thank you very much, Mr. Agarwal, for joining us here on ET Now.